Hello and welcome. Today I'm going to show you how I plan to trade for June 18th when FOMC occurred. And FOMC, it's the branch of the Federal Reserve that determines monetary policy by directing open market operations. And essentially what it means is it's a day where there is potentially a lot of volatility in the market, and we like volatility because those create good trading opportunities. So this is June 18th. I always start the trade by adding in any big buys that happened the day before. So there was a big buy at market closure that happened. They picked up shares at 529.08. So I'll mark the level here. And then yesterday, remember where I like to watch the order flow? 529.08, and there was roughly there was an order that was picked up that never was filled at 532.25, so I'm going to mark 532.25. So sometime in the afternoon yesterday, an investor, and it showed up on the time and sells tape, which you'll find over here, and you'll get used to watching and reading, an order came in to buy shares at 532.25. Well, the market never went up and revisited that area. So going into the 18th market open, I thought, okay, we had investors who bought here at this green level and investors who had bought at the orange level, and this order was never filled. So then I go ahead and I do my typical marking out. Remember, this is pre-market. I'll mark the high, the low, and the middle, and it's no coincidence that this green line turns out to be our low. So when I plan trades, I like to try and get them by calls, which is betting the stock will go up when it's at the bottom of the line, and by puts, betting that the stock will go down at the top of the line, or more upwards action if that's how it looks, or more downward action down here. However, this is the plan that I traded. So after I find those levels, I'll go into the after hour levels from 2 days prior, 1, 2, which is over here, and I'll mark those levels because oftentimes the market will also go in the direction of the after hours from 2 days ago. And so again, it is no coincidence that the market returned up towards that direction. If this was the high, this was the low, and the middle is right there. And then really the market, when it started down here, sure enough, look, it headed into that after hours area from 2 days ago. So I've got now some zones where the market's coming right here. Then what I like to do, I have a reason to get in. I want to get in below where an investor bought a large amount of shares. The order up here was much smaller, but it still needed to be filled, so I have a price target. So those things, a reason to get in, because big investors got in, and an area I want it to go, and that's where there's an order that needs to be filled. Now I've got pre-market levels marked. I want to see, based on pre-market, is there an area that I think it could hit? And here's what you'll do. You'll start to learn trend lines. Trend lines are drawn to help you more visually see the direction of the stock, if it's trending down or trending up. To do that, looking at this, you can see it's downward trending. But what we'll do is we'll find the top of a peak of a spike in the price of the stock and draw the line to the next peak, but continue it out. And then you can do that for the lower stock, the lower side too. So this here shows you it's in a downward trend. To do an upward trend, you're going to mark the bottom when the stock comes down. Let's find a better day. An upward trend. Here's an upward trend. So you'll find the bottom, and then you'll connect it to the next bottom, and you'll draw it past. And you'll see it starts to create this trend line The more you do it, the more you'll get better at it. So pre-market, I'm going to draw a line from the top of that spike to this one and just pull it out. And then you can create channels. Where it will give you the top. And a line that runs parallel to the top. So now you can see that the stock yesterday morning was trending downward in this channel. Now the thing to know about trend lines is it's common for them, the stock, to hit it 3 times. 1, 2, 3. And then either break out or fail. The bottom here, 1, 2. So, oh, look at, we got 2. Well, I thought the third one, if it does, the stock go 1, 2, 3 and fail, there was a possibility I could see that it was going to hit right on the trend line on the third bounce. So then my trade plan for the morning was to pick it up when it hit the trend line and purchase a call betting that the stock was going to go up and hold it until it got to that 532.25. So market opens, and sure enough, it starts coming down. Now you could also get the stock on the downside, but I wanted to be prepared for the upside because that was a bigger move. So market opens, going in pre-market, right before market open, it hit and it started coming down. So I was hopeful that it was going to do it, and sure enough, it came down. So when the stock came down, and it just looks like it's going to keep going, but we have a plan here. So I hit buy as it touched the yellow line, and then I held it and sold it, sure enough, right up here when it hit the price target of 532.25. And that was a beautiful 173% sell. Now, if you didn't have a reason to get in and a determined price target, then you might have gotten a little nervous or wanted to sell when it started going down here. But you'll also learn that this is very normal and actually positive behavior. Stocks don't run in a straight line. So it came up, and then when it hit this trend line, it came out, broke back down, did a pullback, and this also was right around the price where the stock opened for the morning. So people who got in here thinking it's going to go up and it went down, and they went ahead and held it, hoping it would go back up, hurried and sold when it got here so that they could do a break even. And also the market maker knows that we've been running up here. A lot of people are going to say, oh my gosh, we're back up here, I want to catch it now, and they get in. So he'll bring it down so that he can grab more liquidity. So that was an absolutely perfect, beautiful move. Okay, now FOMC was the meeting that was happening at 2 o'clock. So I typically find that there are between 1 and 3 good trades a day. And that was one. So I thought, okay, FOMC occurs at 2 o'clock. And so they'll likely set up a trade prior to that. Now what I was thinking is this green line here is where the big investors got in. And because they're large orders, the market maker usually has to bring the stock back to that area at least 3 times to fill the order. So if my line was a little more appropriate, well, did it come down? Oh, 8. So no, it didn't come down there. So we hit once. Oh, we've got to come back again. So what I did is we're up here at the top, and again, I like to buy puts, betting that the stock is going to go down when it's at the very, very top. So I started watching. Once I got, had closed the upward trade, I started watching for an opportunity to bet that the stock is going to go down, and with a price target of the green line, that it was going to revisit so it can fill that order. So as I was watching up here, remember I said things like the trend line, it will do it 3 times. Well, sure enough, I'm watching, it goes up once, and it doesn't break above this blue line we have from the after hours, twice, and right there is a perfect entry, 3 times. Because the nice thing about this is if the stock goes out and keeps going, It's an easy, like, I was wrong, sell right away. You don't have to wait for your 5% or 10% stop loss. Same with the morning trade. When it hit the trend line, if it, doesn't reverse back up, you can just get out. And also what I noticed at this time is on the time and sells tape, there were sell orders, and each time the sell order would come in, the price would drop. These volume bars down here would turn red. When they turn green, then those sell orders are like fuel for a fire. And buyers, if there's a lot of them, will hurry and pick those orders up and it'll push the price up. Well, they weren't pushing the price up. So good entry to the downside there. Comes down to this white line and bounces back up. No coincidence. The white line is a pre-market high. So people who are watching are thinking, okay, it's going to bounce on pre-market high and go back up. And the market maker knows that, so he'll take advantage of taking people out. Then it comes below the line, one final upwards, and the ball starts bouncing down. So the nice thing about this is it gives you opportunities if you want to add to your position. And at this time, the market maker had also started doing some market making manipulation to show that the price was going to go down. So again, you could just keep adding. Holding it to price target. This trade right here, over 200% return. Okay, there's two trades. One final trade, likely, and this was 1:30, so they had brought it down prior to the FOMC, again at 2 o'clock. Now I'm thinking, okay, we've hit this twice. A lot of people are going to be getting in at the FOMC, and there was some data that was, or information anyways, that was also going to occur at 2:30. So it kind of had two time frames here, the 2 and the 2:31. So what happened? 2 o'clock is approaching, and the stock comes right up to that same pre-market high. Now if you'll look, if this is pre-market high, I said it typically does things 3 times. So this here is basically considered the morning play. And then if you start looking at the rest of the day, it came above here once. That's twice it came up to there. So I'm thinking, okay, I think the bigger move is going to be on the third bounce, closer to the 2:30 information meeting. So 2 o'clock hits, comes down, I'm just watching. Sure enough, comes right back up. 2:30 is when the meeting started. So into that, when it came back up, you hit here. Now the reason why I would be comfortable getting in at this line to the downside, because FOMC, with a lot of volume and volatility, it can shoot right up, is this level down here. If the market maker sold to an investor a large amount of shares, he has to short the market to do that. So he borrows shares from his broker, sells them to the investor, and before he lets the price go above, he needs to buy those shares back, ideally at a lower price, and then he can return those shares to the broker. That's what you do when you short the stock, and then the price can go up. So I was anticipating another drop below our green line here. So you get in here, take a trade to the downside, and then the thing about this one, you just have to think about the mentality of the market maker and how can he get a lot of people to get in and out of shares, because that's how he makes his money. Well, if we're going to have the third bounce here, a lot of people are going to say, oh, it's coming in, let's take the bounce right there. So what does he do? He runs it right past it. And the price will always stop at a place that makes sense. It's never a random thing. So we go back to trend lines. So you're in the stock here. Your price target is below the green line. You want to find a more exact one. Well, when there's a lot of people in, it's not going to be as obvious. But go ahead and find this low down here. Draw a trend line. And it is that you can see the stock kept bouncing off. And it is no coincidence, therefore, that from here it made it all the way down to there and you're out. 3 fantastic trades, this one over 250% return. There you have it.